Hello and welcome back to Cost Accounting. I'm your host, Dr. B. Today we're going to be talking about absorption costing. Absorption costing, the way I want you to think about absorption costing is think about the cost of manufacturing. You have direct materials, direct labor, factory overhead. Within factory overhead, we have fixed and variable factory overhead. The idea behind absorption costing is we absorb the costs of manufacturing, the cost of goods manufactured. We absorb them into the cost of the goods manufactured. We absorb these individual costs. That's the idea behind absorption costing. When you look at your balance sheet, we know we have three different types of inventory. We have raw materials, work in process, finished goods. Those are your inventory accounts. On the income statement, after we sell our inventory, it moves from inventory to cost of goods sold. Now, on the income statement, when we're looking at cost of goods sold, we know that the inventory that we sold is the cost of goods manufactured, direct materials, direct labor, factory overhead, which goes into a cost of a finished product. Now, as it goes into a finished goods inventory, we sell it as finished goods, it becomes cost of goods sold. We know that cost of goods sold is made up of those costs that were at one point finished goods. So when we think about absorption costing, I want you to think about it from the perspective of all of the costs associated with manufacturing and selling our finished goods. From our operations, when we talk about income, we recognize income at the point of sale, right? And when we talk about recognizing our income through absorption costing, we look at it from the perspective of we are absorbing the costs associated with manufacturing and selling our product. So this is what our income statement would look like from that perspective of absorption costing. We have sales minus costs of goods sold. Remember, in cost of goods sold, it's direct materials, direct labor, factory overhead that go into finished goods. Finished goods is an inventory. When we sell it, we take it out of inventory, off the balance sheet, and onto the income statement as cost of goods sold. So sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals operating income. Now you might be asking yourself, Dr. B, why is selling and administrative expenses here in absorption costing? Well, I'm so happy that you asked that question. Earlier we had mentioned that absorption costing, including both variable and fixed factory overhead. If you think about selling administrative expenses, this is a related expense to the selling process, which is why we see those just below gross profit. And that's why they exist on this form of the income statement. We've talked about this concept before, and I want to reiterate what is variable cost. Variable cost, also known as direct cost, which I know we talked about that, is the cost of goods manufactured. It's direct materials, direct labor, and variable factory overhead. Now we see that it's variable factory overhead. It does not include fixed factory overhead. Direct labor direct materials, variable factory overhead. The reason why we take into consideration variable factory overhead instead of variable and fixed is because the variable factory overhead component changes with the level of output, making it, of course, a variable cost. So direct materials, direct labor, variable factory overhead. And within variable costing, we recognize our fixed factory overhead as a period expense. So it shows up on your income statement as an expense rather than a part of cost of goods sold. So direct materials, direct labor, variable factory overhead are part of cost of goods sold, cost of goods manufactured. Of course, cost of goods manufactured when we haven't sold it yet, right? And our fixed factory overhead is recognized as a period expense. So that's something that we see on our income statement as an expense and not a part of cost of goods manufactured, cost of goods sold. In absorption costing and variable costing, there are a couple of recognizable differences here. And the most obvious one is the treatment of fixed factory overhead. In absorption costing, I had mentioned that we absorb the cost of goods manufactured, and of course the related expenses. We see in absorption costing, we have direct materials, direct labor, variable and fixed factory overhead. So in other words, total factory overhead. That's absorption. We're absorbing all of the cost of goods manufactured. Makes perfect sense. Under variable costing, we're absorbing, under variable costing, we include direct materials, direct labor, and variable factory overhead in our cost of goods manufactured. We recognize that the fixed factory overhead is a period expense under variable costing. And to reiterate the fact, the reason for this is because under variable costing, we recognize that variable factory overhead moves with the level of output, whereas fixed does not. Now, when we report our operating income under variable costing, there are a couple of key components that we report. We have, of course, sales. Sales is the revenue we've earned from the sale of our finished goods, minus variable cost of goods sold. Variable cost of goods sold. Now remember, your variable cost of goods sold consists of direct materials, direct labor, and variable factory overhead. So sales minus variable cost of goods sold equals this thing called manufacturing margin. Manufacturing margin is quite simply sales minus variable cost of goods sold. What this represents is the, I guess you could say, the gross profit. Very similar in nature, right? It follows that same principle. So sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses, because we know that there's both variable and fixed selling administrative expenses, but we're only concerned about variable under variable costing because, again, the concept of variable means that it changes with the level of output. So sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses equals contribution margin. Now, hopefully you know what contribution margin is. It's manufacturing margin minus variable selling administrative expenses. Yes, of course. But contribution margin is the difference between sales minus your cost of goods sold, essentially. So the concept here is we look at our contribution margin to understand our gross profit. And then we notice our fixed costs. Our fixed costs are recognized as period expenses under variable costing because fixed costs do not change regardless of the level of output. So we have contribution margin minus our fixed costs. We have fixed manufacturing costs, which is the same as saying fixed factory overhead. And we also have our fixed selling administrative expenses equals total fixed cost. So we have contribution margin minus our total fixed costs equals our operating income. And this, my friends, is how the variable costing reports under operating income. We see, again, the separation of variable and fixed. That's the whole idea behind variable costing and reporting for variable costing. We separate out variable from its fixed components. Why do we do this? You might be asking. Why in accounting? Why in cost accounting do we even care about separating out variable from its fixed components? Well, I'm so glad you asked that. It's because we look at our operations from the perspective of operating income. If we were to simply use absorption costing, which includes both fixed and variable components, we would see a difference in our operating income. And moreover, I'll show you that difference now. Okay. An example. I know you guys love examples, and so I like examples too. It just makes things a little bit more understandable. Okay, here's some data. We have Martinez Company. We manufacture, well, I don't know what we manufacture, something fun. I don't know. Martinez Company manufactures 15,000 units of, I don't know what could possibly cost that much. Something fun for $50. We manufacture 15,000 units and we sell those units at $50 a piece. That's nice. That's decent. Okay, let's take a look at the data related to our costs. We have manufacturing costs, total manufacturing costs, $525,000. $35 total per unit. We break out our fixed and variable components. Okay. Variable manufacturing costs. This would be direct materials, direct labor, and variable factory overhead. $375,000 at a total cost of $25 for variable cost. Then we have our fixed manufacturing costs. 150,000, 15,000 units at $10 per unit, giving us a total of $35 per unit of manufacturing costs. Then you'll see we have separated out selling and administrative expenses for variable and fixed. Now you might be asking, oh, what can be variable with selling administrative expenses? Well, quite simply put, commission, sales commission, right? That could be a variable component to selling administrative expenses. So in our example, we have $75,000 worth of variable selling administrative expenses. At $5 per unit, we sold 15,000 units. I think we sold them all. Looks like we did. And then we have fixed selling administrative expenses, $50,000. You're wondering, oh, what could be fixed, right? Well, as you know, with selling administrative expenses, we have things like advertising and promotion. We have things like sales salaries for the office personnel. We have other potentially fixed components of selling administrative expenses. Our total expense for selling administrative expenses is 125,000. So now that we know our data, let's take a look at this example from absorption costing and from variable costing, so we better understand the difference between the two. Okay, here we go. Now remember, we report it differently. That's why it's we recognize that absorption is different from variable. So let's take a look. We sold 15,000 units at $50 per a piece. So that's $750,000 in sales. Makes perfect sense to me. The total cost of manufacturing, this includes fixed and variable components, was $35 per unit. $35 per unit. We sold 15,000 units. That gets us to $525,000 of cost of goods sold. So what do? Sales minus cost of goods sold equals gross profit of $225,000. Minus selling administrative expenses. Now remember, we're talking about absorption costing. We include both fixed and variable components. Selling administrative expenses, we have 125,000. So take your total. That's 75,000 variable plus 50,000 fixed, 125,000. So we take our gross profit, 225,000 minus our selling and administrative expenses, 125,000, to get us to operating income of 100,000. Okay, not bad. That's not bad. Operating income 100,000, not bad. Okay, now let's see how that compares. The absorption costing model compares to the variable costing model. Sales is the same, 750,000. Now, here's where it gets different. Let's take a look. Sales, 755, that's the same. Then, when we start talking about our cost of goods sold, it's different. Now, let's see why, okay? Variable cost of goods sold. Variable cost of goods sold, that's the key term, yes? We sold 15,000 units at $25 per unit of variable cost. 15,000 times 25 variable cost is 375,000. Okay, interesting. Sales minus variable cost of goods sold equals manufacturing margin. Minus our variable selling and administrative expenses, 15,000 units at $5 variable selling and administrative expense per unit. So 15,000 times 5 is 75,000. Our manufacturing margin minus our variable selling administrative expenses of 75,000 gets us to a contribution margin of 300,000. Okay. Now, here's where it gets interesting from an analytical perspective. Under absorption costing, which was the model I showed you before here, under absorption costing, we have gross profit 225,000. Under variable costing, we have contribution margin of 300,000. Interesting. So here's where, and here's why. Well, there's a few reasons why it's interesting. We see the operating income is the same. That makes sense. It should be the same. But the difference here comes under our contribution margin or our gross profit. The reason why we see such a substantial difference, 300,000 versus 225,000, is because under the variable costing model, we recognize fixed components, fixed costs, as period costs. And in accounting, the word period cost means it simply goes onto our income statement as an expense. So from that perspective, it appears that under variable costing model, we have a higher contribution margin because we period expense out our fixed costs. Now, you might be wondering, why? Right? You're probably thinking, why would somebody want to do that? Why would somebody want to report the separation between our variable and fixed costs in order to achieve a higher contribution margin? Interesting. Well, there's a couple of reasons, a couple of business reasons, right? Number one, it sure does make the company look a lot more attractive with a higher contribution margin, doesn't it? 225,000 compared to 300,000. That's very attractive to an investor. Number two, expensing in comparison to absorbing. What that does is, from a tax perspective, it has different implications, doesn't it? In consideration, right? I mean, yes, of course, the operating income is the same. But from that perspective, it sure is different. Yeah, fascinating. So we got your contribution margin minus your fixed cost. And as I had mentioned, the fixed cost under variable costing is expensed out. So 300,000 minus 200,000 in total fixed cost equals your 100,000 operating income. But that's an interesting comparison, isn't it? Very, very interesting. Under the absorption costing model, having gross profit of 225, under variable costing, contribution margin of 300,000. That's really the primary difference between the two, is how we recognize our cost of goods sold, essentially, right? And that's the part that's most fascinating. So here's an interesting concept. What is the effect on inventory when we compare absorption costing to variable cost? When the units manufactured are the same as the units sold, clearly there's no change on inventory. That's obvious. When the units manufactured are greater than the units sold, there's an increase in inventory. Of course, that makes sense. I have more on hand if I made more and didn't sell the same amount. Makes perfect sense. When the units manufactured are less than the units sold, then clearly there must be a decrease in the inventory on hand. The reason why I'm showing you this is because I want you to understand the comparison between the absorption costing model and the variable costing model and their effect on inventory. Now, here's the nice graphical representation of this. If the units manufactured are the same as the units sold, this means that the absorption costing income is the same as the variable costing income. Okay, makes sense. Now, here's where it gets different. If the units manufactured are greater than the number of units sold, the absorption costing income will be greater than the variable costing income. Interesting. Okay. Here's where it gets more interesting. If the number of units manufactured is less than the number of units sold, the absorption costing income will be less than the variable costing income. So from this comparison, we can see the overall impact that variable costing in comparison to absorption costing has on the inventory, or the opposite, the inventory impact that has on absorption costing and variable costing. That's interesting. Now, in looking at this, what do I do? What do I do? Is it the same? It is the same, right? Yeah, okay. And looking at, yes, absorption and variable costing, effects on income under absorption and variable costing. Yeah, so we can see clearly that there is an impact on the operating income as it is reported under absorption costing and variable costing. What happens with that inventory? So a couple of key impacts from what we just saw. So think about the image. Think about the image that we just saw. So if the units manufactured are greater than the units sold, that means we have an increase in finished goods inventory. Of course, that's what that means, right? I made more, didn't sell as much. That means I must have more in my finished goods inventory. Absolutely, that makes sense. And absorption costing, the increase is related to the fixed manufacturing overhead in ending inventory. This is where it comes into play, okay? Because you're probably wondering, well, how could there be a change in operating income based on whether I'm reporting in absorption costing in comparison to variable costing? The answer is, when I have an increase in operating, when I have an increase or decrease with respect to operating income, based on the change in inventory, and I'm talking about absorption costing, it's because the cost of goods sold includes fixed manufacturing overhead and absorption costing. And so that's why there would be such change. Let's look at an example. Frand Manufacturing Company. They just started operations. So there's no beginning inventory. They estimate in their first, year, they expect to sell 20,000 units at $75 per unit. The company also assumes that sales will not change if we manufacture more than 20,000 units. Okay, so there's two proposals here. Management's trying to decide whether to make more than 20,000 units. If they say, listen, we're going to sell 20,000 units, guaranteed, no problem. What if we decide to make 25,000 units, knowing that we're only going to sell 20,000? Well, as a cost accountant, as a major of accounting, that we would run a differential analysis. Of course we would, for the two proposals. But let's take a look at what that would look like. So proposal one, let's just make the 20,000 that we know we're going to sell. Okay, great. And proposal two is going to be, let's make 25,000. let's look at proposal 1. And we're going to look at this from the perspective of both absorption cost and variable cost. So let's make 20,000 units. Our variable cost is $35 per unit. It's $700,000 total variable cost. Our fixed cost per unit is $20 per unit. How did we get $20 per unit for fixed cost, you might be asking? Well, we took our total fixed amount of manufacturing costs, $400,000, and we divided by the number of units manufactured. So 400,000 divided by 20,000 is $20 per unit of fixed cost. Makes perfect sense, right? You guys know how to do that. So the total cost of a single unit is $55, variable plus fixed, right? Of course. And our total manufacturing cost is $1.1 million, variable plus fixed, $700,000 plus $400,000, $1.1 million. Then we, of course, we have our selling administrative expenses. Variable selling administrative expenses, $100,000. It's $5 of commission per unit at 20,000 units sold. 100,000. And we have fixed selling administrative expenses of 100,000. That includes office salaries. It might include shipping. It might include advertising and promotion, whatever, right? Variable plus fixed, 200,000 total selling administrative expenses. Okay, now that we understand the data, let's analyze it. That's proposal 1. Okay, proposal 1. We're going to make and sell 20,000 units. Proposal 2 is we're going to make 25,000 units, but we know we're still only going to sell 20,000. Let's take a look, see what happens. Okay, proposal 2, here we go. My variable costs are the same, $35 per unit, but I'm making 25,000 units. So that gives me a total variable cost of $875,000. Now here's where it gets different, because remember, in order to calculate the variable cost per unit, you take your total fixed costs of manufacturing and divide by the number of units manufactured. So 400,000 divided by 25,000 is $16 fixed cost per unit, which gives us a new total unit cost of $51 per unit at a total manufacturing cost of $1,275,000. Now you might be thinking to yourself, well, that's interesting because we made more units and the fixed cost per unit is lower. How is that? Well, that's because to calculate the fixed cost per unit, we take total fixed cost divided by the number of units manufactured. That's how we got to $16 per unit in this case. If we look back before, it was $20 per unit. Yeah. So that's a big key difference to take into consideration as we look at looking at absorption and cost in comparison to variable cost. Our selling administrative expenses. Now remember, we're still only going to sell 20,000 units. $5 commission per unit, 20,000 units, that's 100,000 variable. And we also have our 100,000 fixed, 200,000 selling administrative. That part hasn't changed. Let's compare under absorption costing first, and then we'll do it for variable costing, the two proposals. My sales are the same because remember, I'm still only going to sell 20,000 units regardless of the number of units I manufacture. So sales, 1.5 million. Okay, $75 sales price times the 20,000 units. And we have cost of goods manufactured. In proposal 1, my cost of goods manufactured is 20,000 units at $55 per unit. Remember that $55 per unit represented fixed and variable cost per unit. So 20,000 units times $55 is 1,100,000 under proposal 1. Now under proposal 2, remember in proposal 2 I said we're going to make 25,000 units. The total cost per unit in the proposal 2 is $51 per unit. Remember, the reason why it's lower is because in order to find the fixed cost per unit, you take your total fixed cost divided by the number of units manufactured. So your variable plus fixed, $51 per unit. We made 25,000 units. That got us to 1,275,000. Now, here's another key difference. Remember, we said we're only going to sell 20,000 units regardless of the number of units that we're going to manufacture. So that tells us that we're going to be left with ending inventory under proposal 2. Okay, not under proposal 1 because we sold all 20,000 units. Under proposal 2, I have an ending inventory of 255,000. $51 per unit times 5,000 units ending inventory. Remember, we only sold 20,000, but we made 25,000. So let's take a look at the total cost of goods sold. Total cost of goods sold in proposal 1, 1.1 million. Very straightforward. Under cost of goods sold for proposal 2, 1,020,000. How we got that? Take your cost of goods manufactured minus your ending inventory. Get your cost of goods sold. Cost of goods sold, remember? Okay. You take your sales minus cost of goods sold equals gross profit. Under proposal 1, 400,000. Proposal 2, 480,000. Interesting. Minus selling and administrative expenses, 200,000, equals an operating income of 200,000 for proposal 1 and 280,000 for proposal 2. Now, based under the absorption costing model, clearly proposal 2 would be the better of the two options. Now, that may not be the same case under variable costing, so let's find out. So 80,000, okay? Makes great sense. Proposal 2, wonderful option. Wonderful option, absolutely. We, of course, our manufacturing costs a little higher. Makes sense because I made more. But there was an $80,000 increase in my operating income. So proposal 2 is probably the one that management would go for if they're simply looking at the absorption costing model. Now, that may not be the case under variable costing. Under variable costing, the operating income is 200,000, regardless of whether we made 20,000 units or 25,000 units. Now you're wondering, oh, Dr. B, how could that be? You know, that it would be the same. Remember, we only sold 20,000 units. But the key point here is that the fixed manufacturing costs are treated as a period expense. So it gets expensed out rather than being treated as a part of the cost of goods manufactured. That's the key difference. So what does that look like? Okay, here we go. This is the variable costing model. We have sales. Right now, we're just going to compare the first two, okay? We have sales. We're going to make 20,000 units in proposal 1, 25,000 units in proposal 2. Sales, 1.5 million. We sold 20,000 units at $75 a piece. just as before. Here's where it gets a little different. Under the variable costing model, we only take into consideration the variable cost of goods manufactured. Remember, variable cost of goods manufactured includes direct materials, direct labor, and variable factory overhead. So $35 variable cost per unit, 20,000 units, that's 700,000. If we made 25,000 units, that's 875. Minus ending inventory. Under proposal 1, there was no ending inventory. Under proposal 2, I have 5,000 units in the ending inventory, so 175,000 at $35 per unit. So we take our sales minus total variable cost of goods sold. Cost of goods sold. That's the difference here, because I can hear you already. Dr. B, why does it say 700,000 for all three options? Well, because cost of goods sold. Cost of goods sold. Remember, I only sold 20,000 units, regardless of the amount of units I manufactured. That's why it's the same. So 700,000 sales minus total cost of goods sold, variable cost of goods sold equals manufacturing margin, 800,000, minus variable selling administrative expenses, 100,000, equals contribution margin, 700,000, minus my fixed costs. Fixed manufacturing costs, 400,000, fixed selling administrative expenses, 100,000, 700,000 minus 500,000 equals $200,000 of operating income, regardless of the number of units manufactured. Because remember, the key difference between proposal 1 and proposal 2 under the variable costing model is the fact that we have fixed costs separated from the variable costs, and the fixed costs are expensed out as period costs. That's why there's such a big difference. So using the absorption and variable costing models in decision making helps managers to understand how they can control costs, price their products appropriately, plan for future production, analyze market segments, and of course, accounting plays a key role in every decision that management makes. But you all know that. Accounting is the backbone of every business, right? I know it is. Okay. So, accounting reports, whether it be under variable costing or absorption costing, or both, help management to make decisions which result in controlling costs, pricing products appropriately, planning for future production, and analyzing market segments. Market segments, as you hopefully know, is like sales territories and sales demographics, things like that, right? That's more on the marketing side of things. Okay, so in planning production, I want to identify a couple of constraints in manufacturing. When we plan for production, we typically plan based on capacity. The word capacity means how much I can manufacture, how much volume I can manufacture given my constraints, my natural constraints, my warehouse, my capacity, number of hours. Those are my constraints, right? In planning production, is limited to capacity. And because of this, management tries to make decisions on how much inventory we can reasonably manufacture given those constraints. Some products have seasonal demand, some products have steady demand, some products have variable demand, and of course, we manufacture to meet that demand. So all of that to take into consideration how much I should plan for to manufacture, right? And when we look at planning for production, I look at both variable costing model and the absorption costing model. And for reporting, since variable costing takes into consideration contribution margin, absorption costing is most commonly used when management plans for production, because we don't want to take into consideration the margin, yes? And of course, this information helps us to plan for future capacity. So there's a key components here. There's short run and there's long run when we talk about planning for production. Short run means short time frame, obviously, but it also means short batches, small batches, done seasonally, done in short runs, right? Large batches done in short runs. A run, how can I describe this? A run is like completing a certain number of units in a given amount of time. That's a run, yeah? Production run. When we talk about short runs, we're talking about short time frames, and we're also talking about constrained amount manufacturing in a given amount of time. It's a short run. And in the short run, we look at absorption costing as the most logical model to follow. The reason for that is because under absorption costing, we don't take into consideration contribution margin. That makes sense. However, in the long run, meaning long term, looking at full 12 months, looking at all of those components together, it is best to use variable costing because we take into consideration margin, manufacturing margin. So when you look at planning for production, short run, absorption costing, long run, variable costing. The same can be said in marketing when we're looking at market segments to sell our products, to identify costs and determine profitability. We look at both absorption costing and variable costing. Absorption is good for long-term analysis of market segments. Variable costing is good for short-term analysis of market segments. It's the opposite of planning for production. Planning for production, short-term absorption, long-term variable. Under market segment, absorption, long-term. Variable costing, short-term. It's the opposite, yes? But typically, when we look at analyzing market segments, we look at the variable costing most because we take into consideration the manufacturing margin, of course. Let's take a look at an example. Market segments. Market segments in a general sense are things like sales territories, individual salespeople. where we sell certain products, that type of thing. Most of that type of decision making is done by the sales department, marketing department, upper management. In most cases, accountants are not terribly concerned about market segments. The only time that we accountants are concerned about market segments is from the reporting of the data, right? You know, how much was sold in which territories, because that data helps management to drive the decisions. So let's look at this example. We have a fragrance company that sells both perfume and cologne. We have the sales data for both the perfume and the cologne here in the Northern and Southern territories. We have the variable production costs of the cologne and the perfume based on territory. So we can see Northern Territory, 80,000 sales, 80,000 for the Southern, that's 160,000 total. We can see variable production cost by territory, 9,600 for Northern, 9,600 for Southern, 19,200 total. But here's the difference. Here's the difference. In both products, the variable cost of production represents 12% of all sales. That sounds about right. We can see that the perfume, $7,200 in the north, $3,600 in the south, and the cologne, $2,400 in the north, $6,000 in the south, and the respective totals. We can see, just based off of this data, the overall performance for each, for both the perfume and the cologne. So let's analyze that data a little bit further. How much does it cost to sell it? How much does it cost to sell it? Promotion costs. How much does it cost to advertise it, right? 30% of variable sales for the perfume, 20% variable sales for the cologne. You can see the breakdown for the Northern and Southern territories. For sales commissions, 20% for perfume, 10% for cologne, Northern and Southern territories. And you can see the breakdown. And what does this information do? How does it help us? Well, for management, it helps management to understand where the investment is going to when it comes to sales in order to then target the respective markets to sell more of that respective product. That's the whole concept behind this data analysis. Helps management to understand higher profit territories, how to reduce costs in lower profit territories. And that's what that information helps us to do. Looking at the under, let's see, what are we looking at here? Under the variable costing model, we can look at the sales data. Sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses equals contribution margin. We can compute the contribution margin ratio. Hopefully you all remember how to do that. Sales, contribution margin in sales, 43% Northern Territory, 50.5% Southern Territory. In other words, this type of sales data, we can run the variable cost model to understand the overall contribution for each territory. So finding the contribution margin ratio, contribution margin divided by sales, We can also identify the respective sales territory mix. Sales mix, that's a marketing term, business term. It refers to product mix, sales mix, also refers to marketing mix. Um, it, it means a couple of different things, but as accountants, we're typically concerned about the concept with sales mix as it refers to the contribution margin ratio for each product within each territory. And we can, of course, figure this out by taking the contribution margin divided by sales and finding the respective sales mix for each product within each territory. For example, we see the perfume 75%, cologne 25% in the north. And then in the south, we have 37.5% perfume, 62.5% cologne. And that represents our total sales mix for each product. And of course, the more products the company has, we can compute the sales mix for each respective product. And of course, this information helps management to focus their sales efforts to maximize their total contribution margin, which is the objective of pretty much every single business on the planet. So sales minus variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses equals contribution margin. Contribution margin divided by sales gives you contribution margin ratio. And you can do that for each product, yes? Each product, each territory, each everything. That's it's the same exact method. And of course, we can analyze the product profitability based off of that process. You do the same thing for salespeople, just as you could do for sales territories. You can do the same exact thing for salespeople. Each salesperson has total sales, or total sales is derived from variable cost of goods sold, variable selling administrative expenses, contribution margin. Contribution margin can be calculated for each salesperson. And all of that can be included in a salesperson profitability report. Basically, it tells me how well each of my salespeople is performing. So sales minus cost of goods sold, variable cost of goods sold equals manufacturing margin minus variable selling administrative expenses equals contribution margin. Contribution margin ratio calculated by taking contribution margin divided by sales gets us our contribution margin ratio. Interesting, right? Interesting. And again, this type of analysis helps management to best focus their efforts on the right talent in order to continue to build the business. Performance metrics for salespeople include things like sales growth rates, years of experience, customer service, territory size, actual compared to the budget. And all of that data is super helpful for management overall. And that, my friends, brings us to 5 o'clock, and it brings us to the end of week 6 presentation. Are there any comments, questions, or concerns for those of you on the call? With me today, I got Brandon, Paulette, and Santa. Anything at all?
Professor.
Yes, Santa.
So basically the main difference between the absorption and the variable cost is like with the variable, we separate the fixed and the variable. And,
yeah, that's right. Yeah, that's the primary difference between the two models. So under absorption costing, we include fixed and variable components in the cost of goods manufactured. Whereas in the variable costing model, we separate our fixed from our variable cost components. And under the variable costing model, the fixed cost components are expensed as period expenses. So yes, that is the primary difference between the two models.
Thank you.
You're welcome. Absolutely. Paulette.
Hi, Dr. B. I didn't realize I was still on mute, but I'm okay. I think for the most part, I follow along with what you're saying.
Great. Wonderful. Sounds good. And if you ever run into any problems, questions, or concerns, you just let me know, okay? I'll be happy to help you out.
No problem. Thank you.
Thank you. And Brandon, are we doing okay?
Doing pretty good, Professor. I appreciate it. I appreciate you doing these each week. It helps me reaffirm that, I'm on the right track with everything.
Perfect. Perfect. Wonderful to know. Great. Okay. Well, again, thank you all so very much for your time today. I know you're all so busy with your lives and with your work and everything, your families and everything else you got going on in life. So I appreciate you taking the time to spend with me today. I'm glad that these sessions are helpful. My plan is to keep doing them. We got 2 more after this week. We're in week 6. Oh my goodness, week 6, right? Can you believe it? So a couple key things I do want to touch on real fast. This just popped up today. Your login process will change on April 29th. So when you log into UMGC, you'll use your UMGC issued email address. So make sure that you find what that is and make sure you use that to log in going forward for your single sign-on.
Yeah, I think they sent everyone an email, so it's actually in your email. Yeah.
Oh, okay. Good. That's good to know. Thank you for letting me know that, because it's hard for me to tell what the students see. So just be aware of that. That change is coming down the road. And since we're in week 6, this week's a lot easier than last week, right? Not as much going on this week. We have our. I do want to touch on this though. This is important for your discussion this week. It's a peer review. So, and that peer review is of the paper and the Word document that you're hopefully working on for your 10K and for your Excel document. So please, and a PowerPoint presentation if you have one, upload that stuff if you can, even if it's not done, okay, for your peer review, because the idea behind it is you want to solicit some feedback from your classmates. And of course, I'll be in there and taking a look myself, just kind of let you know if you're on the right track or not. But definitely take advantage of that opportunity. It's very, very helpful. And the other thing I want to note, of course, if you have your weekly homework assignment in line. Now, the other important thing to notice is next week's the busiest week of the course. Next week is the busiest week of this course, week 7. I don't know why. It seems like every accounting course, week 7 is the busiest. Couple of key things going on. We got a little discussion. Okay, that's nice. That's cute. Robotic process automation, cost accounting. Yeah, that's a nice topic. But bigger than the discussion, we got exam 3. Okay, we got the 10K report is due. We got the 10K project Excel file is due, and a homework assignment. Oh, I know. Dr. B, you're killing me. This is a lot of stuff. It is a lot of stuff. I know. I'm sorry. I didn't design the course. Otherwise, I wouldn't have loaded week 7 so heavy. So my recommendation is to work ahead. Try to accomplish some of this other stuff for week 7. Just knock it out. I promise you, if you do that, your week 7 will be a lot easier. So just try to look ahead a little bit, okay? Okay. I hope that helps, Paulette, because I know it's overwhelming for me too. That's a lot of stuff.
Yeah, I agree. But once, like you said, if we work ahead a little bit and maybe turn in, I did make an error with homework assignment number 6. I made a mistake and put my PDF, because I always try to do a screen print and attach it to there. So I have to redo it when I do week 6 homework.
No problem. That's fine, Paulette. I saw that you did that, and I left it as it was. Don't worry. I didn't enter any type of grade in.
Okay.
I knew it
All
was
right.
an error. Yeah. But thank
Okay.
you for letting me know. Absolutely. Okay. Any other comments, questions, concerns? Are we okay?
You're okay. Thank you so much, Dr. B.
Thank you so much for your time. Have a wonderful rest of your day. The recording will, as always, will be posted for discussions. Yes.
Do we have,
I'm sorry. You're cutting out there. I'm sorry, Shanta. You're cutting out. I can't. Looks like you might be having some audio trouble. I can't make out what you're saying.
can you hear me?
A little bit. It's cutting in and out. If you like, you can send me an email if that might be a little quicker.
Can you? Okay. I can just send an email.
I can hear you now. I can hear you now. Santa, go ahead.
I just wanted to know if I'm saying we have
I'm sorry, my friend. I can't.
a technology pro.
Oh, the technology report. Yes.
Or something like this. So I'm not.
Yes. Thank you. Thank you for reminding me of that.
Right.
Yep. Excellent. So in week 8, and correct me if I'm wrong, but I believe you're referring to this one right here, the software memo.
Yes.
Yes. Okay. Wonderful. Yeah. So you'll be able to find that in week 8. Basically, all it is it's a 1 to 2 page memo. Just like any other business memo you would write. And what the objective here is to find and write about a piece of software that you found from a cost accounting perspective. So there are softwares out there that specialize in cost accounting. An example of that would be it's called Fishbowl. Fishbowl is a software add-on piece for QuickBooks that helps accountants to identify cost of goods manufactured. So the idea behind this is you want to find a piece of software like Fishbowl or another piece of software that you found that includes cost of goods manufactured. That would be, and of course, it would be direct materials, direct labor, factory overhead, line items for those respective costs that account toward cost of goods manufactured. Raw materials, work in process, finished goods. If you could find a piece of software that has those elements and write a short 1 to 2 page paper about it, summarizing those items that you found in that software, that's what we're looking for.
Okay. Thank you.
You're very welcome. Thank you so much for asking the question. I appreciate that. Okay. Any other comments, questions, or concerns before we end today's session? Okay. Thank you all so very much for your time today. I sincerely appreciate it. I hope that these sessions have been helpful. And if you ever need anything, you can email me, call me, set up office hours with me, whatever you need. I am here for you 100% of the time. So thank you all so much. I'm looking forward to your wonderful work this week and next. And have a wonderful rest of your day. Stay safe. Wash your hands. Do the right things. Thank you so much. Take care. Bye-bye.
Thank you. Good night.
Thank you, Monica. Thank you. Bye-bye.